a single moment hold the key to a brighter future? Join us as we find out. Welcome to the Amplify One Moment virtual event experience. Discover how one moment has defined our story and continues to define a more meaningful way to invest. One moment has the power to define your story too. One moment can change everything, and that one moment begins now. Please welcome Head of Strategy, Richard Bray.
Hi everyone, and welcome to the Amplify One Moment virtual event experience. I'm Richard Bray, Head of Strategy, and it is my privilege to welcome you to this beautiful and meaningful location, the Kruger National Park. As much as today is about one moment, it's about something so much bigger than that. We've always worked towards investment goals and to do good in the world. But over time, we've really grown to understand what this means and how only we are able to deliver that. Today, we're going to be sharing with you the result of all that hard work over this exciting 90-minute journey. Work which started with asking ourselves one simple question: what can one moment do? Can it be the key to better, more sustainable investments? Can it be used to create a positive impact on our world? And can it lead to a brighter future? We really believe so. And we are so excited to share these reasons with you in today's event. We're going to take you on the journey we've been on, sharing our unique investment approach, along with a fantastic lineup of speakers and the chance to engage with some of our investment world's top minds. In a week's time, everyone will receive a recording of this virtual event experience, as well as your CPD certificate for attending. Every moment begins with a choice, and let's go and choose this one moment to change it all.
We're all in search of something greater and more purposeful. We want to leave our mark, realize our goals and do right if we can. But what if we could do it all? Let's uncover what one moment means and how it's amplifying what matters. Life is measured in moments, defining moments. Moments that can have lasting impact, create legacies, build dreams, realize futures. What we do in one moment can make all the difference. At Amplify, we believe in making each one count. That's why we've introduced a more meaningful way to invest. Through proven strategies and solutions, we approach investing with the goal of making a lasting and meaningful difference. Investing with purpose to generate returns and contributing towards initiatives that matter. We call it intelligent impact. It's guided by the expertise of a team of next-generation asset managers who are rigorously and carefully selected for their focus, skill, and approach to risk, who see opportunities and stick to their convictions. Going the extra mile to find competitive advantages that create meaningful returns that matter and make a difference in the world. Together, we amplify what matters. Together, we aim to affect positive change. So, when faced with a decision to grow your portfolio or make a difference, don't choose, do both. Choose to harness all of life's valuable moments, because a more meaningful way to invest is here. Are you ready for your one moment? Amplify. Intelligent impact that matters. Every story has a beginning, a single thought that can rewrite the script. What we choose to do at that defining moment can change everything. How did it begin for us? Let's look closer and meet the people that seized their moment. Please welcome Head of Amplify, Martinez van der Nest.
Nature is something which is close to my heart. It's a place where I love to spend my time, all of my free time. It is probably the best place for people to recharge their batteries. You don't have cell phone signal. You can switch off completely, block out the outside world, and just be in the moment. So because my passion is wildlife, protecting that for generations to come, that is the responsibility of this generation and every generation after it. So for me, it is about ensuring that, we do leave a legacy. And there's also the important knock-on effect on tourism. South Africa attracts many overseas tourists. Those overseas tourists bring millions and billions of dollars and euros that they come and spend here. So it is a massive influence on the economic growth of South Africa, on our GDP. And if we have a thriving tourism industry, it leads to a thriving South Africa. So at Amplify, we embrace the United Nations Social Development Goals. We've partnered with two initiatives, the Good Work Foundation based in the Bosbokrand area and the Environmental Crime Investigation Services of Sandparks. Both those causes are very dear to our hearts and addresses certain of the issues that we believe are critical in addressing the overall structural issues that we face in South Africa on a daily basis. Uplifting the community, giving the youth of the country the opportunity to find a job is critical in ensuring that we uplift the country in its entirety. It works hand in hand with rhino conservation, in that the only way to ensure that the rhinos are conserved is to ensure that the poverty in the surrounding areas are alleviated. A couple of years ago, we came down to the Kruger and we did a rhino scene with the guys from the Environmental Crime and Investigation Services. And it was three rhinos that were poached. They cut the rhinos open to do the ballistic, or to retrieve the ballistic evidence. And one of those rhinos were pregnant, and they took out a little baby calf, unborn, and saw grown men cry. I cried. Everybody cried. And it was there that I then said, this is a cause I really want to get involved in. The future of rhinos for me is, on the one hand, I feel optimistic, and on the other hand, I feel scared. I'm scared because, it could be within our generation that rhinos will no longer be around. But I'm optimistic because we do have the honor, we do have the privilege of spending time with the individuals that are out here protecting the rhinos. People that give all of their time to look after the species. And so with all those efforts, the technology that's being employed, you've got to feel that, that is going to work. That's why I believe that, we will be able to do this, and that is why we are involved in this cause. Intelligent impact for me is really what our business is all about. It starts with being able to find and identify the right managers for our clients. The impact side for me is important because it is a passion. And so the impact that we're trying to make in, first of all, the investment side and ensuring that we do create wealth for our clients is also to be a good corporate citizen. If we are going to grow a successful business with the lofty ambitions that we have for Amplify and the brand, I want to be able to be in a position where we can contribute and plow back into South Africa to create a better tomorrow for everybody. Creating a world and a South Africa where the economy is thriving is dependent on having the ability to create jobs, alleviate poverty, and to ensure that our wildlife is preserved for generations to come.
It's said that if you want to go far, go together. We couldn't agree more. We believe that intelligent impact that matters is best achieved together. That's why we've partnered with an incredible team of people, leading the way in protecting our present and making an impact in their own way. Please give a virtual hand for the first female head ranger of the Kruger, the Rhino Whisperer, Kathy Dreyer.
Hi, I'm Kathy Dreyer and I'm the Head Ranger for Ranger Services in Kruger National Park. Being the first female Head Ranger of the iconic Kruger National Park is obviously first and foremost very overwhelming, but it really is an incredible honor and a privilege to be where I am. And I owe a lot to the people that I've always been very fortunate to surround myself with. Growing up, I always knew that I wanted to do something that involved being outdoors and something that involved working with wildlife. So I started studying nature conservation and just absolutely loved it. I've always loved rhino, and in particular black rhino. And I was really fortunate to do my practical experience in Addo Elephant National Park. And it was a year when they were taking out the wrong subspecies of rhino that were in Addo back to East Africa and bringing in the desert black rhino that should have been there. So I had to do a project, and I decided that I was going to do a project on how to habituate rhino. So some of the rhino we were taking back to Kenya, back to Tanzania, and you literally needed to get them tame enough that you could put them in a crate and be able to feed them by hand. And I quickly realized that if I made them love me more than anybody else, I had to go with them. So having spent so much time with rhino and constantly talking and reading books to them and making everybody else talk to them when they were around the rhino, that's where everybody started calling me the Rhino Whisperer. And the name sort of stuck and has always been what people refer to me as. So I was really lucky in 2016 to be nominated with the team that I had worked with at that stage for the Tusk Award in Conservation. And it's an award that's given to an upcoming and emerging conservationist in Africa that's made a significant contribution to wildlife. So yeah, it was an incredible honor just to at first be a finalist and then to have won it. So being the first female to have ever won the award and then the first South African. And just when you thought it couldn't get better, I was presented the award by Sir David Attenborough. Unfortunately, we all know that in 2008, South Africa saw a rapid escalation in rhino poaching. And in response to that, SANParks is made of a lot of different departments. The Air Wing, we've got Ranger Services, but then we also have ECI, or the Environmental Crime Investigations Unit. So it's certainly because of rhino poaching, the need for the unit developed and it's grown to what it is. But it's also, I always say, we focus on a lot of the negatives around rhino poaching. But if there's one thing that it has done, it's brought so many of us together, working together, trying to solve this and doing so many incredible things together. So as Ranger Services that I head, we work so closely with, in particular, the ECI unit, the K9 units, and then the Air Services unit. We wouldn't be able to achieve what we do if one of those units had to fall away. All of us came into conservation wanting to just be outdoors, connect with nature. We certainly didn't think that we'd be in these positions trying to save such an iconic species as rhino, fighting wildlife crime. To organizations like Amplify that don't know Kathy Dreyer, don't know the field rangers out there, don't know the pilots or any of the individuals, to put their faith and their trust in us as the guardians of Kruger and as the guardians of rhino. I think we're always incredibly touched by how many people out there really want to help without really knowing us, but trust us enough. It's a massive responsibility, but it's also an awesome responsibility that we take very serious. And we would like to, I certainly want to, at the end of my tenure as Head Ranger, be able to walk out and hold my head up high and say, I've made a difference for rhino, and I've made a difference in the lives of the people that are protecting rhino.
Is there any greater impact than shaping the future? We don't think so either. One of our aims is to help future generations and marginalized communities reach their full potential. The Good Work Foundation helps make this possible. Together, we're reimagining potential through education and skills development. Giving back with impact starts close to home for us. Please give a virtual hand for the Good Work Foundation and its fearless founder and CEO, Kate Grosh.
I am a teacher by training. I'm a teacher when I wake up in the morning, and I found myself teaching in rural schools. I'm a math, science and biology teacher. If I look back the 15 years, there's no way I could have even imagined what it would become, but I got started, and I think that's sometimes something people don't do. They don't get going. And I think for me, the biggest thing that I noticed was the disconnect between urban and rural schools. The opportunities for the children are just so different. And I think that was what I was inspired by. These are young people with the same potential, the same passions, the same futures. And so the idea of the Good Work Foundation early on was, how do we make sure that these young people get the same opportunities as everyone? And slowly but surely, I think it formulated for me that if we can shift the education, if we can make sure that every child that leaves school can speak English and speak computer, that connects them into the world. So I think while the focus of Good Work Foundation is education and creating courses for young people to access to, the result of what's happening is a sort of a change in the whole community around here. There's a development in the young people, there's a looking at what kind of careers can we have and how can I move myself, my family and the community forward. Probably about 80% of our staff are women. Over 75% of our students are women too. And we're starting to see these young women step up, take opportunities and move their careers forward. We're also very aware that the young men that are working with us are also really important in the way that we develop our communities out here. These young men specifically are playing the role once they have their day job, which is GWF, but they're also huge role models for the young boys in the schools. So the Good Work Foundation staff are leaders in their communities. They're leaders here. They work really hard when they're here, but even when they are outside our buildings, they are seen as people developing the communities for us. Good Work Foundation has a number of partners, and without them, Good Work Foundation is an idea. They're the energy that keeps us going. But we're very clear at Good Work Foundation, we don't really just want sponsors. We look to connect with people that we resonate with, like Amplify, that we want to create a partnership and a long-term relationship with. Because together as partners, we can evolve that, we can work together and actually guide the program. We wouldn't be where we are if it wasn't for partners like Amplify, because we've got all the ideas in the world, but the energy required is funding. Earlier this year, I read a really interesting article that said, purpose is the new head office, which is really interesting to me. And there is one moment where you get a choice to shift your life and to go towards that purpose. So I think it's our responsibility to understand what our mission is and what contribution we want to make, but you will have that one moment where you make that decision to follow that path. And I see that every day with the young people that step. Their one moment is stepping into the door of this campus. If we're going to have a planet that works, if we're going to have societies that work, if we're going to have a future that works, that's what we have to do.
At the heart of how we create intelligent impact is a group of experts who work together to generate meaningful returns and affect positive change. Guiding that team is Head of Amplify, Martinez van der Nest, and Head of Strategy, Richard Bray. Collectively, They combine their unique insights along with proven solutions to ensure that intelligent impact generates meaningful returns, the kind of returns that matter. Please welcome Martinez and Richard.
You know, intelligent impact is for us is that the world is not all about the bottom line anymore. There is more meaning to it, and actually leaving a legacy for the next generation and more purpose for when you invest. So for us, how do we marry those two principles together?
When we set up the business Amplify from the beginning, the intention was always that it would be an investment business first and foremost. That is our major responsibility, to ensure that the wealth of our clients that is entrusted to us is preserved and grown over time.
It actually started with a personal journey where I went on a course about impact investing because of the trend internationally for it and to create change. It is very concentrated on the institutional market, so there is no access for retail investors to get into impact investing or anything like that because of the lack of liquidity in it. And your average retail investor doesn't want to lock up their money, they want to have that freedom with their money. So it started creating this question of how do we marry this world of impact investing but bring it to a retail level? And the simple answer, and I mean it was actually Martinez who came up with the idea, is, you know, let's first and foremost give the best returns to our clients, find the best asset managers out there, and then out of our profits, we take a section and we give it to philanthropic impact initiatives where we measure what those initiatives are doing in order to generate more meaningful returns for our clients.
So Amplify is unique, first of all, because of the fact that we don't have our own internal asset managers. We look at the market to find who those best and most skillful managers are that we believe would be able to deliver per individual mandate on behalf of our clients.
So the wonderful thing about our next generation asset managers are they are completely aligned with us and our views on the world and what we should be doing. First and foremost, they are passionate about delivering returns to their clients. For them, you're only as good as your last day, never mind your last month or your last year. So it's that incremental adding of performance to the client's portfolios that helps clients grow their wealth. But from an impact side and from an environmental side, all our partners all contribute to initiatives that matter for transformation, environmental and social skills. So to have that alignment and partnership with our next generation asset managers only creates a better world for all of us.
As financial advisors, our world is a lot better when more people are employed, more people are educated, because it grows us as an industry.
You know, in summary, what is intelligent impact? It's two words. The intelligence part is delivering investment returns for our clients. The impact is changing the world for future generations. And it's as simple as that.
So we say that we find the most skillful managers in the market. But at the end of the day, it's about looking at the performance numbers, and what we've done is to give you a quick snapshot of each of our funds and to compare them against the category average that they are listed in. So if we start off, Terebinth Capital manages the Amplify Strategic Income. It has been our fastest growing fund. It has been on the back of consistent returns that has been delivered by the manager since inception. Moving on to Truffle Asset Management, the fund has won the Raging Bull Award for the last 2 years and has been a stellar performer in the category. Matrix Fund Managers manages 2 individual mandates for us. The first is the Defensive Balanced, and that fund since inception is actually the top performing fund in the low equity category and the absolute fund they've been managing for the last 3 years, and that fund has done really well against its competitors. Moving on to the Amplify Balance Fund, managed by Laurium Capital. Laurium has actually been running a mandate like this for over 5 years, managing the Amplify Fund for the last 2 years. And since inception of the Laurium strategy, the fund is in the top 10% of funds within the high equity category. Moving on to the Amplify Flexible Equity, managed by ABAX. ABAX has been managing the fund for 3 years now, and you can see that the fund over the last year has done spectacularly well. But since taking over the fund 3 years ago, the fund has done 2% better than the category average. Moving on to the equity fund. In the equity space, we are actually making a change at the moment. We have appointed Oystercatcher Investments that will take over the management of the portfolio going forward. They are a manager that is striving to achieve higher alpha than our current manager, who is more benchmark cognizant. We then have 7 hedge funds that we actively take to market, and the managers that we've partnered up with in the hedge fund space are really some of the better known managers in the country. We've got 4 fixed income managers, Matrix Fund Managers, Acumen Capital, Terebinth Capital, and Marble Rock Asset Management, who manages our funds. Then we've got 2 equity mandates managed by Oystercatcher and Peregrine Capital, and then Obsidian Capital managing our multi-strategy fund. Please join me for the panel discussions that are about to follow.
To realize opportunity, you have to be able to see the bigger forces at play in the bigger picture, especially when the world faces greater uncertainty and increased geopolitical instability. But by remaining calm in the storm and staying focused, you can find clarity. You can continue to generate the investment ideas with impact. Let's take a look at the macro picture and meet the people still realizing opportunity. Please welcome Eric Nell of Terebinth Capital, Carmen Nell of Matrix Fund Managers, Melanie Stockett of Laurium Capital, and Richard Bray of Amplify.
Morning, everyone. Thank you for joining this morning and everything, and it's a great privilege to have all of you on a panel. Carmen, you've been covering financial markets for well over 20 years, both with local and global international banks. What is your outlook with regards to inflation for the year ahead?
Well, the short answer would be that inflation should moderate, both specifically in the US as well as in South Africa over the course of the year. In both instances, it will probably be quite sticky early on in the year. But I think the debate is not whether it moderates, it's really how quickly it moderates. So in the US, you could have a scenario where, yes, it rolls over back towards sort of 2 to 2.5. Rather, you're looking at a more plausible scenario where it's sort of stuck between 3 to 4% at the end of the year. Or if it moderates only to about 5, which would be quite high in the US context. I think for South Africa, the big question really is what happens to the oil price. That's sort of our wild card, because we don't have a lot of pricing power in the economy. So it's really exogenous inflation, and if oil doesn't unwind or increase, we could have quite a sticky inflation profile this year.
And I heard quite an interesting stat, and I'm willing to be corrected on it, that apparently local inflation, South African inflation, is actually lower than US inflation since the 1980s. Is that right?
Yes, so we've actually been lower now for a number of months. There was a brief period sort of in the mid-2000s, I think, where we were slightly lower. So yes, it is quite remarkable, because in SA, we usually have the high sticky inflation, obviously thinking back over the last 20 to 30 years. So the big debate in the US really is this only sort of frictional inflation? In other words, because of the supply constraints? Is it maybe a bit of cyclical inflation, so supply and demand, which certainly, in our view, it would be a case of both supply sort of disruptions and lockdowns in the face of very strong demand. So again, if you think about prices, they're the intersection of supply and demand, any price, right? And you've got now a shortage in a lot of goods at a time when you've given, stimulus checks to households in the US. So the demand's very strong. So therefore, there is a risk that you sort of have much stronger cyclical inflation coming through, which would require a more aggressive policy response in the US.
So how aggressive do you think that policy would be?
Yeah, I think so. You've seen the market shift quite rapidly, but I think one has to be cognizant that there is a lot of sensitivity to the level of interest rates in the US. So I think we could look at something like, so on the Fed funds rate, currently the upper target or upper limit is 0.25%, so basically zero. They could probably get to something like 1.5%, which in SA context sounds very, very low. But in the US, it is 4 to 5 hikes that would be needed. And then probably they'll pause to see how things unfold, and then possibly resume hikes in 2023, assuming that they don't undergo a hard landing. So the Fed's sort of trade-off is to address these inflation pressures, so lower demand in the face of constrained supply, but not to the extent that you cause a recession. So what's interesting is people are calling the pending rate hikes by the Fed a policy error, but we could easily argue that the fact that they continued to do QE and effectively stimulated the economy throughout last year, that could have been the policy error. So sort of you needing another policy error to fix the previous policy error, so sort of two wrongs have to make a right.
Absolutely. Because, I mean, and Eric, just to pull you in here as well, I mean, I was reading one of your weekly commentaries and you even pointed out, more textbook theory is that you start increasing interest rates after you've had a lot of growth in the economy and there's confidence and low volatility. But obviously those factors are not what we're experiencing right now.
Yeah, so I think 2022 is going to be a little bit more tricky than the historic periods of exiting, and I agree with Carmen, probably over easy policies in some extent. If we consider the actions of early 2020, both on the fiscal and on the monetary side, it was very, very aggressive. And in some instances, probably not really necessary, given that it was a health crisis. So I do think that if we think about 2022, it's probably more going to be about coordinated policy exit rather than just focusing on monetary policy. So what I think is currently happening, especially with the Fed, is they're trying to address some of the issues with language, and the market wants to kind of front run that to some extent. And so in answering the question around how much they should hike interest rates, that really needs to be answered almost with a subsequent question regarding quantitative tightening. So I don't think they really need to hike interest rates too much if they run down the balance sheet slightly more aggressively than some assumptions currently would involve. And specifically for the reason that they've got a huge debt problem. I mean, the world has a debt problem. So this whole notion around R-star, I think, has changed quite a bit.
And if I could possibly just add to that, so just listening to you, I completely agree with what everyone has said so far. And I think if we wind back to that idea of a policy error, I think if we go back to 2020 when COVID hit, we saw policymakers in the US and everywhere, policymakers, whether it's monetary policy or whether it's fiscal, on the fiscal side, saying they'd rather do too much than do too little to prevent this idea of permanent scarring so that economies wouldn't be able to recover back to full strength. And I think what we're seeing now is the price that was an active choice at the time, and this is the price that's being paid right now. I mean, if we look at US inflation 7.5% with interest rates at emergency levels, we've never seen inflation so high at the beginning of a tightening cycle, and with interest rates at these emergency levels still, quite some time post the COVID period.
And I think the point you raised is sort of the recency bias in terms of the lessons learned by policymakers is they don't want a repeat of what happened after the global financial crisis. But the big difference is, and Eric noted it, this was not a balance sheet recession, whereas the global financial crisis was. And at the time, they arguably didn't do enough. So they did all the QE, but the fiscal sort of leg was missing because there was a lot of focus on fiscal sustainability. They were actually consolidating fiscal positions in the developed world. Whereas this time around, what monetary policy in the US got wrong is they didn't sort of contract when the fiscal impulse came. So you had monetary policy and fiscal, the point of fearing doing too little. But that to me was the big difference this time around. It's not QE causing goods and services price inflation, it causes asset price inflation, but it's that fiscal impulse that sort of exacerbated the supply-demand.
Eric, to bring it back to the local, I mean, you've worked on the buy side and the sell side. Do you agree with Carmen's view on the local inflation outlook? What impact will that have on the yield curve, especially on the longer side?
Are you allowed to disagree with your wife? I don't know.
It's so interesting for me sitting in the middle of these two, who I've known them both for such a long time, and now I have to be the buffer
wise
zone.
man once said, always agree with your wife.
Well, actually, before you answer that question, I actually want to, for our viewers who don't know, Carmen and Eric are husband and wife, but obviously work for different companies. But every household has a budget, every household has a monetary policy, let's call it that. So who is Minister of Finance in the Nell household?
Not I.
That is an excellent question. And I'm
Back to
very
inflation.
intrigued to hear the answer. Moving swiftly on.
In my recollecting of Carmen's answer, it kind of focused predominantly on the global inflation outlook, not so much on the local side. I somewhat agree with the global side, but again, I want to emphasize that we're going through an extremely tricky period. And so, we've analyzed the current investment environment as tricky and tactical. And the trifecta effect that Terebint is talking about is the risk of tightening monetary conditions, which means tighter credit conditions or difficult credit conditions. And the risk is that the fiscal impulse also starts slowing, especially if it turns negative. The complexity with the current inflation outlook globally, is a geopolitical angle. If you asked us a year ago, would oil prices be approaching the triple-digit levels this year? It was not obvious to us why that would be. Even if we were supporters of the reflation theme back then, our view was that you'll have the first sharp impulse of a reflation theme, then a mid-cycle kind of reset, and then the rejuvenation of the reflation theme, but growth and inflation starting to peak and roll over. And so while you still grow above trend, that pace starts slowing down and the pace of inflation starts slowing down. So that remains the broad framework. But for now, the theme at the moment, I think currently globally, is that inflation is a bit more sticky because there's still too many questions. And South Africa, at the end of the day, is a small open economy. It's a price taker on the global stage. All prices are very important in South Africa. What's currently helping South Africa is the rand. I think if the rand weakens for whatever reason, be that local idiosyncratic political issues or global issues, we've got problems because on the administered side of things, we're not moving in the right direction there. And so we've got it in our within our own grasp to fix some of these problems through reforms, etc. So what that means for the yield curve, may seem optically steep. What's hard to disentangle when you look at the yield curve specifically is how much of that steepness is a function of our credit worthiness now. So it's come back a lot, and it's probably come back to the extent where a lot of the good news of tax windfalls, a better deficit, maybe slightly lower debt levels is probably pretty much in the price. And from here on, I'd say the easy part of that flattening is now out of the way. Now you've got to start doing the right things for further flattening to take place.
Melanie, you've also had your experience in banking over many years, specifically interest and liquidity management. How does corporate credit get affected in all of this?
So corporate credit, really, when we think about that, we can think about that in two ways: what's happening in the global credit markets, and then bringing some of that back to the domestic credit markets. And if we think of the global credit markets, we've picked up on the themes already around quantitative easing and extraordinary policy by policymakers around the world. First of all, post the global financial crisis, 2008, 2009, and then obviously accelerated during the COVID pandemic period of 2020, where we really saw central bankers widen their toolboxes in terms of asset purchases and stimulus of liquidity within markets. And that really directly benefited much of the credit asset class, so the corporate bond asset class globally, where we saw search for yield and we saw extraordinary liquidity conditions, which really pushed investors down the credit curve, so taking on more risk perhaps than they usually would. And now we're faced with almost a nexus or a turning point, a U-turn in that type of cycle, where we're seeing, first of all, quantitative easing becoming quantitative tightening, which we've already touched on, as well as interest rates rising. And a very interesting data point perhaps to look at is the 10-year German bond yield, which has been trading at negative yields for some time. That's now kicked up, and this recent bond sell-off has kicked up into positive territory. So we're faced with a situation now where interest rates are rising, developed markets are behind the curve. ECB will probably lift interest rates towards the end of this year and at some stage into positive territory. So cash as an investable asset class is actually returning, and that hasn't been present in European markets for so long, which will impact the credit complex in terms of spreads.
Melanie, obviously you covered credit, from a global perspective, but with regards to the local credit market, what are your views?
It's a very different market domestically than globally. So globally, investable asset class, you can invest in markets and disinvest with abundant liquidity and actually express a view. Domestically, our credit market is structured somewhat differently. So we have a market where we don't have a lot of issuance into the space, and we also don't have the ability for diversification. And there are many reasons for that. We don't have strong credit extension domestically, so corporates aren't necessarily using the corporate bond market as they would in a thriving economy. Many reasons for that, but essentially we're left with a market that we would say is relatively inefficient. And why I say that is, there are credit spreads that move, but more as a result of supply and demand of flows into funds as opposed to responding to the economic cycle. So it's a very different type of market, so it doesn't tick all those boxes for us.
Yeah, and I think sort of the fact that it is a buy and hold market just sort of reinforces the inefficiency. So there's no true price discovery. So if you look at, for example, the spreads in the corporate bond market versus effectively the spreads in the SA government bond market, if your highest credit in the economy is trading at par, slightly wider compared to, say, your banks. So yes, I would agree with Melanie. It's not a liquid market and there's no price discovery. So it is really very much a buy and hold type of asset class in South Africa.
Today's virtual experience is obviously called One Moment, the Amplify One Moment. So within your own experience and long careers, what has been your defining one moment?
I think it's not my defining one moment. I think it was a defining moment in how you would have to adapt, whether it's your style of analysis, the approach you take, and particularly to the local fixed income market was basically negate, because the dynamics underlying our fiscal and fixed income markets, our fiscal position and how that impacted the fiscal market, and then also how it impacted on sort of monetary policy making in South Africa definitely shifted. So you couldn't take your your pre-Nenegate models and textbooks and just apply them to SA. In this cycle, the curve should do that. And it's just because we had sort of a structural shift in sort of the political and the political economy, and then the local sort of economic into fiscal into domestic fixed income. So I really had to adapt the way I thought about what is the yield curve telling me versus sort of pre-Nenegate.
And my answer would have actually been very similar. So I do find that being a fixed income manager, we're very focused on risk first, return second. And I find that having managed fixed income money in South Africa for so long, the defining moments that I will always remember are the crisis moments. So GFC, I remember exactly where I was when we saw the first distress. I remember Nenegate, I remember exactly where I was, what I was doing, and the conversations I was having. And the same with COVID. And there've been a few, so those are just the three that stand out. But that's really, I think, where you earn your stripes as a portfolio manager, because exactly as Carmen was saying, you've got to rethink your framework and you've got to learn from those experiences. And that over time just makes you understand how global markets fit together so much better. So, we do carry the scars and we do carry the learnings from those experiences. Yes, exactly, for sure. But I think that it's necessary. Managing money in an emerging market, it's a very necessary experience to have gone through.
So Eric, you've got a few more lines on your face than the two ladies here. So
I'm older though. My answer is going to be very different, and it's a bunch of moments, but I want to answer it more from an industry perspective. And so when we put this business together, we had two objectives in mind, which was to advance females in the industry, for very good reasons, not because they're just underrepresented, but because of the balance, gender equality brings into risk management. The other side of it was this paying forward concept that we had at the start, and how long it took to drag people over the line. You know, you walk into an office, very well-known allocators, and they see your name as Erik Nel from the groot plek met die groot voels en die harde eiers, and they don't trust you. So they look you in the eyes and they say, we don't believe you. We don't believe you that this is the guy that you want to be.
Carmen, Melanie, Eric, thank you so much for your time this morning. It's been really insightful and a great experience sitting here with the three of you. And thank you very much to our viewers for watching.
When finding opportunities, it's important to find income. How can you balance growth if you don't have any? So let's journey further and discover how fixed income can secure further opportunities. Please welcome Nomatibana Matshoba of Terebinth Capital, Lawrence Pretorius of Matrix Fund Managers, Barry Ross of Marble Rock Asset Management, and Chris Hall of Amplify.
Thanks, guys, for joining us, and thanks for actually dressing up and not having your Zoom clothes on, as some of our viewers might actually be wearing. But yeah, on the fixed income panel, thanks very much for your time, and yeah, let's start it off. Nomatibana, yeah, you've got a lot of extensive experience in research on the fixed income side. Can you, well, actually a lot in credit actually, but also a little bit more recently in government bonds. Just to start it off, can you just tell us the difference between the two?
Sure, thank you, Chris. The main difference between the two instruments is really around who issues the instruments. So as the name suggests, with government bonds, those will be issued by the national government in the respective country. And then with the corporate bonds, they'll be issued by private companies and also public companies in the respective country. So you can imagine that it really boils down to the credit quality of these two names. And with government bonds, if I zoom in specifically to them, these are instruments where the government has the ability to tax the population and also to levy the population and also to print money. So in which case, the bonds will have a better credit quality compared to typical corporate bonds.
You say that, but recently our government debt actually got downgraded. I mean, we're basically at junk status now. Wouldn't a corporate credit, something like one of the big banks, actually be less riskier than some of our, well, junk status bonds?
So I can appreciate that in the thinking that corporate paper in South Africa will be better quality compared to government bond, especially given what you mentioned around the fact that we were under or downgraded, and also given the fact that the corruption that we've seen in the media around government. But at the end of the day, when it comes to corporate bonds, you need to assess the bottom-up fundamental of the individual credit name. So that speaks to the credit quality of this instrument. And as I mentioned that, and also when it comes to the credit ratings, speaking specifically to the government credit rating, all corporates in South Africa will be rated relative to South Africa's credit rating.
Okay.
So there won't be a point where you have one corporate in South Africa having a better credit quality than the government bond.
Lawrence, you actually, well, we heard Martinez actually saying in the previous discussion that you guys manage two of our long-only funds and then also an award-winning fixed income hedge fund. Do you actually allocate to credit?
Yeah, so I think the important answer is no, we don't allocate to credit per se. And to contextualize that, we don't have any problem associated to credit. We are definitely more on the active scale in terms of our investment processes, also in terms of our asset allocation processes. So for that, we require, for that nimbleness and agility, we require liquidity, and we focus on the more liquid side of the market across equities and fixed income. If you incorporate credit in your investment process, we think of it as a rather static driver of return rather than something that you can actively move out of and move into an alternative asset class or an alternative opportunity. So by means of an example, if you want to change your duration, you can't necessarily sell the credit bonds that you have and buy longer dated credit bonds or the inverse thereof.
Just for the viewers around, some of those instruments, typically then government bonds, if you would say, because they've been most traded on the JSE as well. So typically things like that, cash.
Government bonds, money market instruments, and if we were to venture into credit, and that's a very loose definition as well, certainly we would limit ourselves to bank senior debt, and where we find a little bit more liquidity there.
So quality names, sovereign debt, nothing too risky in that sense.
But with a strong emphasis on liquidity as
yes,
well.
yeah.
Just to go back to what Lawrence was saying, and our philosophy on credit is actually very similar in that regard, that we would really look at that portion of the portfolio as a cash enhancement portion of the portfolio. It's not an active part of the portfolio. As Lawrence said, there's not a lot of trade there, and you can find static prices in the markets that you actually get very little feedback from the market. There becomes incrementally less information in the price, the less something trades. So that creates extra risk for taking on that credit. The market hasn't validated that credit risk in the price. We don't really look at SOE debt. We stick to senior bank paper to soak up cash and manage the credit in that regard, but it isn't an active part of the portfolio at all.
We heard in the previous panels people talking about growing inflation in South Africa or rising inflation in South Africa. Obviously offshore that's pushing quite high, and that is benefit, or we're going to see some rate hikes.
So from the Strategic Income Fund, there are many instruments you can use in order to hedge against rising inflation, but the most typical one that we use is inflation-linked bonds. So those will definitely benefit in a rising inflation environment. So we have, the skill set we have in the team is such that we can pretty much build long positions without necessarily moving the market. Anyone can throw 100 million or billion into the market, but then you're going to move the market.
Yeah.
But it's about building that position without necessarily moving the market in totality. When it comes to structural inflation in South Africa, there is a risk of what's happening currently with the SARB and National Treasury around possibly reducing the target band. So even though we like inflation-linked bonds, we are tactical in how we invest them in the portfolio, because we understand that where that target were to be reduced, then this asset class would suffer. But currently it is providing us with inflation protection.
The last question for the panel today, and as you might have realized, we've got a one moment theme happening. What is your one moment in fixed income where you would actually grant or gain opportunity for investors?
I do think that from a post-COVID perspective, the easy gains have been made in most asset classes, including fixed income. So therefore, coming into this year, the one moment is really about the downside protection. So that I'll say is the key thing for this year.
I've got a much longer answer, but may I say that I do agree with her that the easy gains have been made. Maybe I'll dodge the question a bit and say that we really don't have one moment. I certainly don't have one moment, but I think of it as a continuum. And again, more in a multi-asset context. I personally think South African government bonds, let's take a 10-year bond as a benchmark, has shifted in terms of its real risk premium. It used to be in the region of 3.5%. It's definitely shifted to 4.5% as a real return associated to bonds. And as you may know, in our asset allocation process, we like to formulate a base case return outcome and alternative outcomes and scenarios associated to that. And it so happens that we're actually less dramatic on bonds, and we recognize the shifting 4.5 real yield as a base case scenario, but our distributions around that isn't too particularly dramatic to the downside or to the upside. And in conclusion to my answer, my long-winded answer, I would therefore say that this then renders it as an asset class as a very, very relevant return driver of real return outcomes and a real return objective, if you want. And I certainly would say my moment would be that may this continue, that new money that we get can be reinvested at a 4.5% real return, and current money that we have don't suffer capital losses on it. Our intention is certainly not, in terms of our bond allocations, to be unlocking quick value out of bonds, but rather to be relying on this persistent real return driver. So I would say the one moment is actually a continuum, and I think it's going to be a quite likely outcome.
Yeah, I think for us as well, to have one moment kind of implies something a little bit binary, that you're waiting for something in the market that you yes or no, and you're right or you're wrong. I think that we, on aggregate, look for opportunities that, is for investment opportunities where the current consensus isn't there. And for example, a short rates position coming out of COVID, I think people still had the reflex to look back at previous cycles and expected rates were going to stay low for a long time. So we've had that view, and it's built incrementally over time. And I think that the moment is when finally there's some sort of market catharsis and it converges to your view and validates a more realistic price.
Well, Nomatibana, Lawrence, Barry, thank you very much for your time. Everyone at home or in the offices or wherever you're watching this, enjoy the rest of this virtual experience.
In a world where price is relative, how do you find true value? Value with the potential to grow. Value that's diverse in nature and more than just the price. Let's better understand this value and the valuation of equities with our next guest. Please welcome Matthew DeVet, Investment Manager of Abax Investments, Leon Michaelides of Matrix Fund Managers, Jonathan DeToy of Oyster Catcher Asset Management, and Suvira Boda of Amplify.
So Leon, you joined Matrix, but before that, you were the head of research and portfolio management at another leading asset management firm. In your broad experience, what do you think are the expectations for developed market returns versus emerging market returns over the year to come?
At the moment, we're in a bit of a unique situation from a global perspective. We've got an unprecedented amount of stimulus that has been dumped on the world economy. And at the same time, we've had a lot of demand buying brought forward as people have spent less money on services, travel, etc. And I think that the result of those two effects is that companies' profits have grown massively as supply constraints, etc., has led to a bit of inflation. And at the same time, the lot of goods being sold has also led to more volumes through companies. And at the same time, the higher stimulus has led to very low real interest rates, which meant a higher valuation multiple. So at the moment, we have a rather unique situation where investors investing in DM have the unfortunate privilege of paying a very high price for very high earnings. Our view is that's not sustainable. The stimulus needs to get withdrawn. Economies are opening up, and we think earnings also start needing to normalize. So we see earnings growth in the developed markets starting to slow down, and we think the multiple that investors are going to be prepared to pay for earnings that are slowing is going to be less. So our view, we prefer emerging markets where they're trading on multiples that are far less demanding. They've got decent earnings growth prospects. The economies, by and large, are ahead of the curve as far as tightening and withdrawal of stimulus, where the developed markets still need to withdraw all this excess liquidity out the system. So we do have a preference for emerging markets, and within emerging markets, we have a very strong preference for South Africa.
Maybe just to add one or two things on top of what Leon said, I think when you look at emerging markets, he's very right to point out that the different regions have different prospects. I think we'd say the same thing about developed markets at the moment. We see the US particularly as being very expensively valued. You can look at things like the price-earnings ratio, which Leon pointed to, but I think that's masking the fact that company profits are extremely high and company margins are extremely high. So if you want to try and normalize that, you can look at a different ratio, something like the price to sales, which is actually now at an historically high level, higher than even during the tech boom of 99, 2000. So we would be wary of the US in particular, but other developed markets, the UK, Japan, they actually look far more reasonably valued, and we think that the prospective returns there are still decent.
So Jonathan, Oystercatcher is definitely an up-and-comer in the asset management arena. Your investment philosophy does lead you to sort of pick stocks that are more quality biased, that have low leverage ratios. So in your opinion, does that lead you to rather pick Rand hedge stocks over sort of SA Inc. stocks?
So I mean, at Oystercatcher, we have a bottom-up valuation-based investment philosophy. So we spend a lot of time engaging with management and assessing the quality of management and assessing the quality of the industry in which that particular company operates in. One of the key components of our process is what multiple do you pay for that earning stream? Now, if you've got a business which has got huge moats around it, and it doesn't need a lot of leverage in order to generate a high return on invested capital, that type of business you're happy to pay a higher multiple for. So something like a ShopRite. We are still going to be eating food in 20 years' time. We may not be going to a Checkers store or a ShopRite store to buy our food. It may come to us on a bike after we've ordered it on the 60/60 app. But that business model is very defensive, and it's not easy for another competitor to break into that. And then we have our ranking table, our valuation guide, and we buy stocks which show the best expected return. But if you get two stocks with similar return, but one is a high-quality stock with a good management team, you'd rather put capital to work into that.
So Matt, you were head of investments at Net Group before you had joined ABAX. Given your experience and what we've been talking about, where do you see the best performance and the worst performance for the coming year coming when we talk about SA equity?
We've been pretty excited about the SA market generally for the past couple of years. And I think there's still quite a lot of value in the SA market. One other area that we're very excited about is, in the SA domestic space, there are a number of very high quality, sort of mid-sized businesses that are off the radars of most of the large asset managers. Companies like Santam or Italtal are extremely high quality businesses that are attractively valued, that are great ones to tuck under the pillow for the long term. And there are also a few businesses with extremely good growth prospects, which is not always easy to find in SA. A company like Transaction Capital, which recently bought We Buy Cars, or PSG Consults, for us are businesses that have long growth runways ahead and are still attractively priced. So those are areas where we are finding a lot of opportunity at the moment.
I mean, ESG is definitely a hot topic now more than ever in our space, but do you believe that investing on an ESG basis actually contributes, or maybe does it detract from returns? Is it something that is a useful screen to use when investing?
I think good ESG is absolutely critical to the investment case. So as a generalization, good ESG habits from a company should lead to better, more sustainable returns. I do think, though, that there's more focus on ESG now in a narrow sense when ESG has always mattered. And the way to deal with ESG, in our view, is to integrate it completely into your investment process and decision making.
So we can see that investing with the ESG mindset does lead to positive outcomes. What about your perspective, Jonathan? Do you think that it can contribute to returns overall?
Yeah, but I mean, in terms of our process, we give every company an ESG/risk score, again, from 1 to 4, 4 being poor and 1 being excellent. And as Matt was saying, I really do think it needs to be a phased approach. Where we were 10 years ago, I mean, ESG is certainly the buzzword nowadays, but there are some companies, Sasol for instance, the Fischer-Tropsch process that they use is a very dirty process. Taking coal and turning it into fuels is a dirty process. There's nothing that they can really do about that. But they are talking about and they are looking at ways to either use natural gas instead of coal, or even going the whole hog and getting all the way to using green hydrogen, which would be fantastic because you could then produce that from renewable energy and it would make it significantly better. So it needs to be a process. It can't be a switch where you just put a whole lot of companies and say those are on the banned list. We don't agree with that. Companies need to go in the right direction, and it's going to be incremental and it's going to be over a number of years, and the world will get to a better place, but it can't be done overnight.
So Matt, of course having the right expectations of returns is important, but risk management is as important. How does that play a role in your portfolio construction methodology?
Yeah, I think it's crucial. So if you look at the Amplify Flexible Equity Fund that we run, The objective of the fund is to capture 2/3 of the upside of the market and 1/3 of the downside. So that's actually, if you think about it, a dual objective. An upside capture, but also downside protection. So there's an asymmetry to that objective. So how, when we construct the portfolios, can we achieve that asymmetry? Well, of course, asset allocation and stock selection is vital, but we actually try and seek out other kinds of instruments that have a payoff profile that is more suited to our objective. So for example, we've made prodigious use of convertible bonds over the years, which have bond-like characteristics on the downside, but potentially equity-like characteristics on the upside. We like to invest across the capital structure to find the area which has the highest and most appropriate risk-adjusted returns. So for example, finding a high-yield bond with an equity-type risk premium baked in, or for example, in the property sector, favoring the A units, which get first dibs at the income stream. We often overlay protection strategies over either our individual equities or at the index level to provide some downside protection. And if we can't find the payoff profile we're exactly looking for, we can actually engage with the investment banks and get them to build specific notes for us that have a payoff profile that is best suited to what we're achieving. So our view is if we combine all of that in a portfolio, hopefully we can get to our objective without taking more risk than we need to.
Thanks, Matt. Talking about risk management and asymmetric returns just makes me think of a hedge fund. And Jonathan, your hedge fund has done phenomenally well over recent years, up more than 38% actually over the last calendar year. Do you feel like it's harder to take a short position in a hedge fund rather than a long position?
So, I mean, we run the long-short hedge fund, the Amplify long-short hedge fund, and it is, we can take longs and shorts. Shorting isn't a large percentage of our return. Generally on shorts, we like to, it must add on an absolute basis. So we like a share that has got a lot of debt in its balance sheet. There typically has to be an event, because just with a lot of debt doesn't mean that the share price is going to go down. So you want that event, and then you want the market to start worrying about that event and its balance sheet. And then you get that return outcome where you'll get a share price that will fall significantly. So no, it's not more difficult, but I mean, it is very much part of our process. It's one of the 14 strategies we run in the hedge fund. So it is not the biggest part of the return profile, but yeah, we are able to take short positions.
Great. So guys, one last question for this panel discussion. If I had to give you one moment to decide what your favorite stock of all time is, what would you say? Leon, you first.
Okay, good question, but we actually don't look at the world like that. And in fact, in our process, we've got mechanisms built in to make sure that we don't end up with favorite stocks that we keep going back to time after again. So we rely on a systematic approach that screens stocks for strong earnings momentum and good valuation opportunities. And we use that to drive where we focus our research effort on. Then when we do our research of companies, we also like to look at things slightly differently there. We don't value stocks using the normal black box approaches to valuation, so we don't rely on DCFs or single point price to earnings valuations. We like to take the company's key valuation driver and backsolve for that and see what that means for the share price, and then look at different scenarios around that. That way we end up having a discussion around an investment case of the company by talking about real-world business drivers, the impact of that on the share price and where the stock should be trading. And we therefore have a much richer risk-reward view of each share when we invest in it. So right now, I'd say using our process, that is actually steering us into some stocks and some maybe sectors that are probably a little unpopular. And then similarly on the local front are the hospital stocks, very unpopular, would never be someone's pick through time. But right now, earnings base very low, about to start increasing as earnings come through from people going back to hospital to do elective surgery. So that's another case where we see earnings momentum improving off a very low base and making a powerful investment case with a cheap valuation.
How about you, Jonathan? What are your thoughts?
Yeah, look, I mean, so part of our process, we try and identify what we call primary growth stocks. So that's generally a stock where it is owner managed. So it is the owner that originally started the business, brought it to the listed environment and continues to manage the business, and also operates in a niche and has carved out a niche where you can see on a 10, 20-year growth profile that there's going to be a lot of growth there. So an example of that would be Equitas, which is a small property counter. Andrea Taverna, the CEO, I mean, when it was unlisted, he brought it to market, walked a long road with him since 2014, and they build distribution centers which is basically a primary beneficiary of e-commerce. Now we know e-commerce penetration is going to continue for the next 10 years. The growth may not be as fast as what it has been, but there's going to be more requirement for distribution centers. So backing that management team, giving him the capital, walking that journey with him. And why I say primary growth is you can see that it's got a number of years of growth ahead of it.
What about your favorite, Matt?
Yeah, it's a bit like asking someone to pick their favorite child. But BMW is a company that at the moment for us would tick a lot of boxes. So it's a family-owned business and has been a family-owned business for most of its history. And they've been a family that's allocated the capital in the business very shrewdly. Most people think of BMW as an auto manufacturer and compare it to other auto manufacturers, and its rating is certainly similar to other auto manufacturers, which is very low. It's on a low single-digit multiple of earnings. But in our mind, it's much more than that. It's a luxury consumer goods company that has manufacturing prowess, but it's also a bank, and it's actually a very high-quality bank because they finance the purchase of BMW vehicles. They have very few bad debts because if something goes wrong, they take the vehicle back and they repurpose it and put it back into their distribution channels. They own the majority of BMW China, along with a local partner there, which is a market that's growing incredibly quickly. And a large part of their market cap, around a third of their market cap, is actually in cash. So it's a very conservatively managed business. So to have a business in our mind of that quality, with that much cash on its balance sheet, on a multiple of 5 or 6 times normalized earnings is very attractive.
Thank you guys for spending some time with me and sharing your thoughts with me today. And thank you, ladies and gentlemen, for joining us for this today.
Generating meaningful returns means knowing where to generate them. To do that, sometimes a broader, more encompassing view is necessary. A view that can see interconnectedness and manage risk above all. Let's join our final group of how understanding the broader view leads to meaningful returns. Please welcome Brian Thomas of Lorient Capital, Ian Power of Truffle Asset Management, Richard Simpson of Obsidian Capital, and Emma Pretorius of Amplify.
Morning, Jane. So I think I'll start by putting Richard in the hot seat. I think quite a few of our managers have been talking about the importance of macro in their investment process. So could you maybe just elaborate on whether the same applies to Obsidian and specifically with regards to the hedge funds relative to the traditional long-only fund?
Yeah, I think so. We at Obsidian manage both long and hedge fund product, but equally important is a macro view. I mean, we appreciate that in South Africa we're a relatively poor quality emerging market, and so we're very buffeted and influenced by what goes off and around the world in terms of the macro environment. So it's critical for us to have a macro view for sure.
What would you say are the most important macro factors influencing your asset allocation at the moment?
So, I mean, again, South Africa is in the main is a commodity country. So we're very dependent on exports of commodities, and that in turn influences our currency. So those macro drivers that influence the commodity cycle are absolutely critical for South African valuations in many respects, including the rand, including many of our listed counters.
Okay. And then Ian, to you, congratulations on the wonderful performance of the Wealth Protector in 2021, all the awards, and 2 awards last year and another Raging Bull certificate a few weeks ago. So what do you think has been the biggest contributing factor to that success, other than being such an exceptionally competent portfolio manager?
Thanks, Emma. I think one of the biggest drivers for us has really been the management of risk through what's been quite a volatile period. And I think that really talks to the way we think about downside risk and I guess building the portfolio in a way that still manages to achieve those double-digit returns that we're aiming for, but at the same time keeping principal or the capital safe through stock selection and some of the equities that we pick, And then also from an asset allocation, I think we've managed to avoid areas in sectors which have suffered, either from multiple contraction and or sort of earnings collapses over the last couple of years. And I think, the combination of that has made quite a nice, low vol, resilient return profile for our clients.
And then, Brian, I think it's fair to say that there's been an unprecedented demand for fixed income products. It's partly due to obviously the rocky equity returns, but also the very attractive yields offered. Do you think that fixed income can give you a high enough return to really grow your portfolio?
Emma, we think about it at Lorem over the very long term. So if you look at a 60-year history of the markets going to 2020, and you look at the returns that equities have given you relative to fixed income, equities have given you about 18.1% over 60 years. If you look at the bond market over that time, it's given you 10.5%. And inflation has surprisingly been around 8.5%, 9%. So your bond returns have only just beaten inflation. And for most people investing, the biggest enemy is inflation. You're wanting to beat inflation. Bonds have come through a very attractive time and have attracted people into that fixed income market because, as you allude, the equity returns over the last 5 years or so, except for last year, have been pretty pedestrian. But I think if you look at that long-term history, as I mentioned, we are firm believers in what is known as the equity risk premium. And the equity risk premium is the difference between the returns that you get on equities relative to bonds over time. And I've illustrated that that's roughly 8%. So we would think for a person saving for retirement, being in a high equity product is something that you really want to be in over the long term.
Okay. And on that note, I know you are, or the balance fund is a high equity balance fund. Do you always have the full exposure to equities, or would you, when you foresee some potential volatility, would you deviate from that at all?
We are very active in managing the exposure that we have to equities, fixed income, and then to equities within South Africa and for the amount that we're allowed to have outside South Africa. So we would take a macro view at any point in time as to which asset class is going to generate the best risk-adjusted expected return and would have the highest allocation to that asset class within the parameters that one's able to invest in. So Regulation 28 and then obviously the Reserve Bank requirements of the fund.
And so, knowing now your views on asset allocation going forward, with there being slightly more volatility, do you think, how would that play out this year? Do you think you might be allocating more to fixed income or stick to your guns?
So at the moment, we're actually overweight South African fixed income relative to our strategic asset allocation, and we overweight South African equities. Within the international component of the portfolio, we're underweight fixed income, and we are also underweight international equities. And we will move that allocation around over time to try and achieve the best risk-adjusted return for the portfolio.
And something that differentiates Lorem and obviously how you manage the balance fund is that you tend to have a small allocation to African equities and bonds. What would be the benefit of doing that as opposed to, say, just investing in Argentina or some other kind of emerging economy?
I think that's a good question. Firstly, we believe we've got a skill set in managing African assets. We've been managing African assets ever since Lorem started 13 years ago, starting in equities, but also fixed income for some time. So we have some selected equity positions, individual equity positions within the balance fund, and then we invest in our Lorem Africa bond fund, which is primarily a euro bond fund, which means that it's all dollar-based assets that we invest in. That fund yields 8% or so in dollars at the moment, which we think is a very attractive yield to be invested in. And the reason that you get such an attractive yield is that the risk perception of investing in African bonds is a lot higher, we think, than the actual risk of investing in those African euro bonds. They're dollar denominated, your money never really goes into Africa. Your repatriation risk is pretty low. And when you're sitting on an 8% yield in dollars, we think that's a very attractive yield. The added benefit of both the African equities and the African bonds is that they tend to have a diversification benefit across the portfolio.
Ian, you obviously manage quite a broad range of funds across different risk spectrums. So how does your equity allocation for our product, which is a low equity fund, work? Is it a house view, or are there certain equities that you would, for instance, not exclude from the more cautious portfolios, but you'd be happy to put it in the balanced fund, for instance, or how do you approach that?
Yeah, so Emma, we focus very much on protecting capital in the wealth protector. I mean, as part of our mandate, we don't want to expose clients to a negative return. So within our equity offering at Truffle, obviously our best view goes into all portfolios, but in the wealth protector, for example, if we've got an underweight position relative to the respective benchmark, we wouldn't necessarily hold the underweight position in the wealth protector. In other words, we wouldn't hold a stock for benchmark reasons. Here we're focusing on those real returns that our clients are looking for. We're focusing on the preservation of capital. Hence looking for, or to only include those shares where there is that asymmetry, where there's that value underpin, certainly where we can see with relatively low risk that the securities are able to deliver the CPR plus targets and benchmarks that we're looking for.
Richard, we've heard quite a bit about the more traditional multi-asset approach. So I'd like to know your views on, naturally, when there is more volatility, when you have a traditional long-only fund, you can maybe move to fixed income or cash, or you can move to more defensive equities. But how do you approach increased volatility? How do you use your additional tool set that you have to your disposal to manage that?
So, Emma, in a hedge fund context, we obviously have more arrows in our quiver. So the key one, of course, is the fact that not being a long-only product, we've got the advantage of being able to short as well. So, you can identify assets that are overvalued. In a long-only context, you obviously just can't own those. But in a hedge fund context, you can actually sell them and benefit from the relative performance of those overvalued shares versus long assets. So to a degree, that helps in terms of volatile markets. But at the end of the day, we apply a fundamental approach to investing, very similar to Ian and Brian. We assess valuations of asset almost irrespective of volatility. Volatility is a very difficult instrument to try and assess, isn't it? So at the end of the day, all you've got to hang on is margin of safety, and build up a portfolio with assets where you think there's enough margin of safety to manage through volatile times, and that's it. But from a hedge fund context, it's the extra arrows in the quiver, if you want, in terms of being able to short as well.
So last question for the day, I have to ask you, what was the one moment in March or 2020 that you thought, okay, I'm ready to dip my toes back into the real estate market or property market?
Do you want me to go first?
Yeah, you can go first.
Look, the way we see it is property sometimes behaves like a fixed income asset and sometimes it behaves like an equity asset. Given the volatility of property, as you alluded to over the last few years, it definitely has more equity-like properties to us at the moment than fixed income-like properties. So yes, you're getting the yield, but you do have the volatility associated with the property. It was an incredible performing asset class last year in the South African market. What we've done is take advantage of that. We have trimmed some of the property exposure that we have in the fund. We're sitting underweight property and with very selected exposure in the property that we have in the fund at the moment. Given our medium-term outlook, the property is probably going to be a reasonably tough space to be from here.
Emma, I mean, we went into the COVID sell-off fairly defensively positioned. From an asset allocation point of view, we had a lot of hedges in place, and so we were feeling, a little bit more. We had a high appetite for risk, and I think in most of the funds we looked for, from a REIT perspective, a few of the counters where we felt that the underlying, assets were still decent. And where either the capital structure, they had a little bit too much debt, but where there was a mechanism for them to sort of get out of that, and we sort of dipped our toe in the water. So I think it was a measured approach.
I think it was about 2 o'clock in the morning on a stormy night, and we had an epiphany that the sector was undervalued. No, I'm joking. I think I can't add too much more to what the other guy said. At the same time as the property sector was sold off, some of the other equities, domestic-facing equities, retailers especially, as well as some of the banks, also screening very attractively and also driven by the same interest rate drivers, if you want. And we just felt there was more margin of safety in those sectors. So we were very much more biased towards the domestic-facing equities than we were in property. But we picked a little up, but not with a huge amount of conviction.
Thanks so much for your time, guys. I really appreciate it. It was great having you here. And yeah, thank you for joining us, and hopefully we'll see you next time.
There are many moments in life. Moments that went by too fast. Moments that you wish you had a second chance to redo. Moments that are worth waiting a lifetime for. Whichever moment is your next one, don't pass on it. Use it. Use the moment to create change, just as we have. That's true power. That's real impact.
Hello everybody again. So we've told you our story, we've walked the journey, we've heard from the experts, and we've capitalized on the one moment. As this one comes to an end, it's up to you to decide what you will do with your one moment. Before we go, I'd like to thank you for joining us on this incredible 90-minute journey. A special thanks to our experts and our speakers for sharing their knowledge today. And hopefully we've been able to give you insight into purposeful investing and how it can help shape a different world that is more meaningful and impactful. As mentioned early on, we will be sending you a copy of the Amplify One Moment virtual experience alongside your CPD certificate pending FPI approval. For more information on meaningful investing and more specifically intelligent impact, visit our website amplify.co.za. At Amplify, we believe in the power of one moment. After this one, we believe you will too. Thank you again, and goodbye.
So, when faced with the decision to grow your portfolio or make a difference, don't choose. Do both. Choose to harness all of life's valuable moments and amplify them. Choose to leave a lasting mark. Choose to realize your goals. To have a purpose. To do good. Are you ready for your one moment? Because a more meaningful way to invest is here. Amplify. Intelligent impact that matters.